That's not why we're having a surge in ESOP activity now. This surge is the result of the aging of the baby boom generation. Those people that were born between 46 and 64 that have a company and are at the stage where they need to have a liquidity and succession strategy. So this surge is a 20-year surge in ESOP activity
Wow.
because this is not driven by tax law changes. This is driven by the silver tsunami.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koch, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
Today's episode, we're sitting down with Kelly Finnell, one of the nation's top experts on ESOPs. We're breaking down what an ESOP is, how it can benefit both owners and employees, and why this unique exit strategy might be the best option for preserving legacy and creating long-term growth. Whether you're building to scale, planning your exit, or just want to better understand your options, you're going to get a lot from this conversation. So let's dive in. All right, everybody. Today's guest is Kelly Finnell, one of the nation's foremost experts on employee stock ownership plans, or ESOPs for short. Kelly's the president and CEO of EFS ESOP Consultants, where he and his team have spent more than 40 years helping hundreds of companies design and execute ESOPs. He's also the author of The ESOP Coach, Using ESOPs and Ownership Succession Planning, which you can find on Amazon. It's considered to be the definitive guide on ESOP strategies, making things simple. And we're going to talk a lot of things today when it comes to ESOPs, but these are one of these succession plans that have great tax benefits, but they're not exactly the easiest to understand. But over the course of Kelly's career, he's published dozens of articles, presented at more than 300 conferences. He's actually, I think, in a hotel room presenting at a conference right now. And he's become a consistent leader in the ESOP community through organizations like the National Center for Employee Ownership and the ESOP Association. He's also served in leadership roles across both professional and community organizations, from the Economic Club of Memphis to the board of Renaissance Bank?
Yep, that's exactly right.
Well, at the end of the day, when it comes to understanding how ESOPs can maximize shareholder legacy, minimize taxes, and preserve company culture, Kelly is one of the best voices you could hope to hear from. So, Kelly, thank you so much for joining me today. This is going to be a lot of fun.
Well, I'm looking forward to it. It's great to be here.
Yeah, well, let's just jump into it because as I mentioned in the intro, ESOPs, I think of all the different types of succession plans, strategies for selling. ESOPs are probably, I'm just stating my opinion here, but they're probably the most misunderstood, if not confusing, especially from an ownership perspective. Can you start maybe just by explaining in simple terms what exactly an ESOP is and why business owners should even be paying attention to them, let alone consider them?
An ESOP really is two things in one. For a business owner, an ESOP is a liquidity and succession strategy. So it would be in the same category as selling to private equity or selling to a strategic buyer or selling to your management team through an MBO. So it's in that same category as a liquidity and succession strategy for a business owner. From the employee's perspective, an ESOP is a form of retirement plan. So it's a first cousin to a 401k plan. There are some key differences between an ESOP and the typical retirement plan that allow it to serve both of these purposes. So the first difference is that an ESOP can borrow money. 401k plans are prohibited from doing that. The second difference is that an ESOP can engage in certain transactions with parties in interest, and I'll come back and explain what that means. And then the third difference is that an ESOP is required to invest primarily in the stock of the sponsoring company. So when you add those three things together, what happens in the typical ESOP transaction is that a business owner has an attorney establish the ESOP plan and trust. The company goes to a bank and borrows money and then relends that money to the ESOP. The ESOP takes that cash and supplements it with what we call a seller note, simply an IOU from the company to the owner to pay the owner in the future. And with those two sources of capital that the ESOP trustee transfers to the business owner in exchange transfers his stock to the company. And then those shares are divided up among the employees over a period of time. And so, one of the natural questions is, why would a business owner go through that complex process when they could alternatively sell directly to their employees? And the answer is because of the tax benefits. If you have a 100% ESOP owned company, then that company is going to operate on a tax-free basis. That company is going to operate like a church or a synagogue. No tax on its income at the company level because it's going to be a flow-through entity, an S corp, and no tax at the shareholder level because the only shareholder is going to be the ESOP trustee. And like a 401k trustee, an ESOP trustee is a tax-exempt entity. And so when we tell people that they can operate their company tax-free after they've gotten this liquidity and taken care of their employees, their first reaction is, well, this is too good to be true. It's not going to last. The IRS must not know about this loophole. But the reality of it is this has been part of the law since the late 90s. Everybody at the IRS knows about this, and in Congress. This is not a loophole. Public Supermarkets, which has 300,000 employees covered in their ESOP, is the largest ESOP-owned company in the country, and they compete very well with Kroger and their other competitors because they've got a huge pricing advantage because they're not paying tax. And they've got a huge employee incentive advantage. And if you walk into the two stores side by side, you'd be shocked in the difference between the way you're treated in one store versus the other, because at Publix, they are owners of the company and they are highly motivated to provide tremendous customer service.
I think you've already touched on kind of what I wanted to drill down into here, but let's drill down. Let's take one side and then the other. So first of all, what would you say? And by the way, I love how you called it. It operates like a church or a synagogue. That's perfect, by the way. But what would you say? Let's start with employees. What would you say is the biggest benefit of an ESOP for employees, or benefits? You can say more than one.
Well, let's compare it to a 401k plan. So in a 401k plan, typically, in order for an employee to get a contribution to the plan, they have to contribute their own money. Employees don't contribute money to an ESOP. It's fully funded by the company. There are no matching contributions. The employees don't put any of their own money into this plan. So that's a tremendous advantage. Statistics indicate that on average, companies contribute 4% of pay to a 401k plan. Statistics also indicate that the average contribution by a company to an ESOP is 10% of pay. So as an employee, I don't put anything in. The company is going to contribute 2.5 times more than they would to my 401k plan. And I get all of the tax advantages in my ESOP like I would get in my 401k plan. No tax on the contribution, tax deferred growth. And finally, I don't have to make any investment decisions like I do in the 401k plan. The stock of the employer is going to be, if not the only investment, then the principal investment that is in my account.
Doesn't suck.
No, it doesn't at all.
What about owners? I know you said that it operates tax-free, right? But there's other tax benefits as well, maybe some intangible benefits. Can you share a little bit about, what's in it for the owners?
Yeah, you're exactly right. There are tax advantages for the company and for the owner. There was a section of the code that was introduced in 1984. So again, long-standing provision, well-tested, not a loophole. And that provision under Section 1042 of the code allows the business owner to sell their stock to the ESOP and reinvest and not pay tax on the gain that they would otherwise have from the sale to the ESOP. So this is a like-kind exchange provision, and many business owners know about like-kind exchanges because they may have done a like-kind exchange of real estate. And so the concept in a like-kind exchange of real estate is that I own a piece of property. Let's say it's a piece of commercial property. I sell that property, and if I reinvest under the rules for a like-kind exchange of real estate, then I don't pay tax on the gain from that sale, but I do get a tax or a transferred tax basis in the second piece of real estate that I bought. Same thing applies under Section 1042. I own stock in my company. I sell that stock to the ESOP. I get cash and notes. I reinvest that in the stocks and bonds of a U.S. domestic operating company. That's like kind property. So I don't pay tax on the gain from the sale to the ESOP. I get this transferred tax basis. Most of the business owners who are doing ESOPs and doing this 1042 like kind exchange are baby boomers. And so they're older. And their goal is to reinvest in property that will provide them an income for life. And then at death, their estate gets a stepped up basis, and that tax deferral becomes a tax forgiveness. So a tremendous benefit for the company, for the owner, and for the company's employees.
Win, win, win. Yeah.
Yeah.
Now, what makes a good candidate for an ESOP? Obviously, there's going to be some companies where it makes a ton of sense, some companies where it makes 0 sense whatsoever, and then
Yep.
probably a continuum in the middle.
Yep. So let's talk about financial metrics first, and then we'll talk about the intangibles. So on the financial side, the best candidates are companies that have at least $2 million of adjusted EBITDA and that have at least 35 employees. So our typical candidate over the last 4 years, the biggest company that we worked with had over 70 million of EBITDA. The smallest one had 1.2 million, but our typical client has $4 million of adjusted EBITDA and 95 employees. And so that's really where the ESOP market is. I tell people that ESOPs are for small to mid-sized companies, but they're not for micro companies. There are lots of expenses involved in establishing an ESOP. That when people ask me what the biggest negative of an ESOP is, I always say, and I can say this because I've been a member of the Tennessee Bar for 45 years now. The biggest problem with ESOPs is that there are too many lawyers involved. And with that comes expense. And so a micro-sized company, a company with less than $1 million of earnings, probably can't afford the expenses that produce all of these great tax benefits. So those are the financial metrics. In terms of the intangibles, if I talk to a business owner and during our first meeting, I ask the business owner, what is the key to their success? And if he or she says company culture, then I know they're a candidate. If they sell to a third party, that third party prior to the sale is going to tell them, look, nothing's going to change after we buy your company. And that's the second biggest
Yeah.
lie in the world. If somebody pays for your company, then your culture, your company culture is going to become their company culture. So a lot of our clients are service firms, where all of the company's assets leave at 5 o'clock and come back the next morning. And the owners want to continue the culture, not just for the benefit of their employees, but also for the benefit of their customers and clients. When company culture changes, it affects everybody, internally and externally. And so that is a big consideration when a business owner tells me that they want liquidity, but they want to maintain the legacy that this company represents for their family. I had a business owner in my office one time who said, Kelly, there has been a company in this city with my family's name on it for over 100 years. I don't want to sell to a third party and have that change. He said, this is how 3 generations of our family have been identified. And he said, I want to maintain this legacy, but I need liquidity out of the company. And so an ESOP is a great strategy in that situation. And ESOP can also be a strategy when you have a company for whom there's not a natural buyer. So some businesses hire an investment banker. That investment banker takes them to market. They do a process. And sometimes the answer comes back, there is no private equity firm out here who's interested in buying your company for a reasonable price. They'll lowball, but that
Yeah.
happens. I mean, that's reality. And an ESOP gives a business owner the opportunity to create a buyer. You set up an ESOP plan and trust, the trustee becomes the purchaser of your stock. So you can create a buyer where a buyer might not otherwise exist. So those are some of the things that we look at.
And how would you say they stack up against, I mean, you touched on it a minute, but how would you say it stacks up against, other M&A or succession strategies, like private equity, strategic buyers,
Yep.
family succession?
Yep. An ESOP is allowed to pay the highest price that a financial buyer would pay. So a classic example of a financial buyer would be a private equity firm that is not purchasing this company as a platform or as part of a roll-up. ESOPs always pay more than private equity in that situation. There are some third-party buyers, including sometimes private equity, that are strategic buyers. And so they're buying this company as a platform, and they're going to come in and gut senior management and install their own people, and then purchase similar companies and roll up an industry niche. In that situation, that third party buyer might very well be able to pay more than an ESOP. The definition of a financial buyer is somebody for whom 1 + 1 always equals 2. The definition of a strategic buyer is someone for whom 1 + 1 might equal 3 or 4 or 5. And so they will pay a higher multiple, not because they're generous or because they're desperate, but because they're going to gut company expenses. They're going to install things that they euphemistically refer to as synergies. And that's a code word for cutting and slashing from the company's employees, reducing expenses. In my 45 years of experience, we have never had a situation where the ESOP didn't pay as much as the best offer a company got from a financial buyer. And so there is a misnomer out there that in order for a business owner to be interested in ESOP, they have to be willing to accept a lower price than they could get on the market. And that is probably the biggest misconception about ESOPs. That simply is not true. And I've got 45 years of experience that proves that.
That's actually a great segue because my next question was going to be about myths or misconceptions. You hear about these things because I think anything that is complex or confusing, I think that you can play the telephone game, people can make things up. They can say it looks too difficult, so they're just not going to do it. So you start hearing these myths. What are some of the
Yep.
biggest misconceptions you've heard when talking to clients or prospective clients about ESOPs?
Yeah. Well, we touched on the first one, which is
Yeah.
the ESOP's not going to pay as much. The second one is what you mentioned, it's too complicated. I've been through transactions with private equity with clients and have been through hundreds of transactions with clients in ESOPs. And a sale to a third party is at least as complex as a sale to an ESOP. Not only is it at least as complex, it's far less pleasant. When you're dealing with private equity, you're in a negotiation with parties that have very sharp elbows, and it can be a battle to get to the finish line. There's statistics that indicate that something like 60% of the LOIs that are
Wow.
executed never result in a closed transaction because that process is so contentious. An ESOP is an arm's length process, but without the sharp elbows. The trustee in the ESOP is the purchaser of the stock, and that trustee's goal is to make this happen for the good of the company's employees. So they've got a fiduciary responsibility to make sure that they don't overpay for the stock that they purchase, but they are motivated to make the transaction happen for their constituents. And the trustees' constituency are the company's employees.
So our audience is both business owners, but also financial advisors. And so, just for a moment, for the financial advisors and fiduciaries listening, how would you say they should be thinking about ESOPs when advising their business owner clients? And for the business owners listening, I think this will be good to get behind the scenes and see what, the kind of stuff we're talking about behind the scenes.
Yeah, I think that um, financial advisors should educate themselves more about ESOPs. They know about sales to third parties, but it will give them a competitive advantage in the market if they can offer additional alternatives. And so an ESOP could be that additional alternative. And financial advisors can get educated pretty easily about ESOPs and how they work and who's a good prospect for one. My mission when I wrote my book, The ESOP Coach, was to explain ESOPs in understandable language. There were lots of books out there that were written for lawyers and CPAs and investment bankers that uh, use financial jargon and very complex terminology. My book doesn't do that. My book explains ESOPs for the business owner audience. I wanted to call it ESOPs for dummies, but that's an expensive franchise to get involved
Yeah,
with.
you get a
And
trade,
so,
then you'll need a trademark attorney too.
yeah, exactly. And so I would suggest to financial advisors to just learn about this option. Don't automatically assume that it's not right for a client. And once you learn about ESOPs, and as I said, you can do that pretty simply. It's not a heavy lift. But once you learn a little bit about ESOPs, and it will expand uh, your bailiwick and give you the ability to identify situations where an ESOP might be appropriate.
And after you've been doing this almost 4 decades now, right? So,
Yeah,
or more than 4 decades. I
yeah,
mean, what trends are you seeing? I know you said this, this all started in the late '90s, but are you seeing any trends now in
yeah,
ESOP adoption, regulation, business
yeah.
owners?
Let me talk about trends that I've seen over my career. Um, in 1984, there was a huge trend towards companies looking at ESOPs. And the reason for that is, as I mentioned earlier, that's when Section 1042 was added to the code. So there was this huge buzz about business owners being able to sell their company to an ESOP tax free. And so for 3 or 4 years there was a tremendous surge in ESOP activity. Then, as I've mentioned before, in the late 90s, Congress passed a provision that allowed S Corps to do ESOPs and allowed for this thing that we call the ESOP tax shield, which is the ability for a company to operate on a tax free basis like a church or a synagogue. So that change in the tax law resulted in a big surge of ESOP activity. There has been an even bigger surge in ESOP activity over the last 5 years, even bigger than the prior two. This one will last. Those didn't. Those were 4 or 5 year surges that were due to changes in the tax law. That's not why we're having a surge in ESOP activity now. This surge is the result of the aging of the baby boom generation. Those people that were born between 46 and 64 that have a company and are at the stage where they need to have a liquidity and succession strategy. So this surge is a 20-year surge in ESOP activity
Wow,
because this is not driven by tax law changes. This is driven by the silver tsunami, the aging of the baby boom generation.
that makes a lot of sense. And I think I'd like to hope or think that companies are becoming more culturally aware. They're you're seeing less in terms of just getting selling to the highest bidder, and if they're the right candidate, making sure that that the executives stay intact, that you know the people who help build the company continue to build the company. Wouldn't you agree?
Yep. I co authored an article a few years ago directly on your point. The article was published in Compensation and Benefit Review, I'd written, lots of articles for tax journals, but this is a peer-reviewed academic journal. I'd never done that before. It's a whole different process. And the title of the article is Compassionate Capitalism and the Use of ESOPs. So my definition of a compassionate capitalist is somebody who wants to do well for he and his family while at the same time doing well for others. And those others are often the company's employees. But many of our clients, when they do an ESOP, also set up a charitable giving structure at the same time, because they're not just focused on feathering their own nest. They want to do well for themselves and their family, but they also care about others. They're compassionate capitalists. And so, yeah, I think you're exactly right.
Compassionate capitalists. I love that. All right. So to wrap up, if there was one piece of advice, and you're not just limited to one, if there's something else you want to share, please drop the knowledge on us here. But if there's one piece of advice you'd give business owners who are just starting to think about, an exit, and might be considering ESOP, what would that be?
It would be just to educate themselves about this other alternative. And when you talk to your investment banker and he tells you, no, we don't need to think about that, ESOPs never work, don't believe him. The reason he's telling you that is because he doesn't do ESOPs. He does sales to private equity. And so just educate yourself. And I've given you some good tips, I think, on how to do that. So just learn more. Go to the ESOP Association professional organizations. There's one called the National Center for Employee Ownership, and that can be found at nceo.org. There you will find a list of ESOP professional advisors, and you can sort that by your location. You can also go to the ESOP Association of America, which is our other industry association, and get some useful information there.
Awesome. I'm going to make sure we put those in the show notes as well, by the way. I'm just typing them down here. So nceo.org.
Yep.
Awesome. All right. Well, that's our time for the day. You mentioned earlier, and this is really important to me because I'm a huge proponent of educating in a way that you could teach a fifth grader. And I think so many professionals, especially in our space, in the financial advisory world, but attorneys, doctors, even. I think too many times, I don't know how much it's intentional, but I think too many times we use jargon, we use words maybe because we're insecure and we want to prove how smart we are. And I think in reality, the best way to show how smart you are is just to explain something to someone in a way that actually makes sense. If you can teach someone else, you're empowering that person to make decisions through you because they actually get it. So check out Kelly's book, The ESOP Coach, on Amazon. I'm going to check it out. I'm really interested because every book I've read on ESOPs has been exactly as you described it. So I'm looking forward to reading yours. Check out nceo.org. You can find Kelly on LinkedIn, both by searching his name as well as ESOP Coach. And then his website is execfin.com. That's EXEC, F as in Frank, IN as in Nancy.com. And as I always say, there's thousands and thousands of podcasts out there, no shortage of podcasts these days, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.